Looking at the electric vehicle market, we think that there'll be 60 million units sold in the next 5 years annually. And, that's up from, single digit percentage points as a percentage of auto sales today. So I think that Tesla here is really in the lead. They have a multi-year advantage over competitors. It's, again, that verticalization strategy that keeps them in the lead. So we think on an efficiency basis, per cost for the price that you're paying for the car, they're still way ahead of the competition. And, I'd be pretty scared if I were a traditional automaker right now and I saw Tesla cutting prices, I'll tell you that.
In this video, ARK Invest Tasha Keeney talks to a few NPCs on Yahoo Finance, discussing autonomy, Tesla's execution, their short-term gross automotive margins, the bigger picture, and plenty more. Plus, GM have officially announced they're giving up. No, really. More on that later. Plus, more research from Morgan Stanley suggesting that legacy automotive manufacturers might take this opportunity, I'm not kidding, to slow down their transition to EVs. Seriously. Actually, seriously. And to be honest, it's a dumb idea, but legacy automotive manufacturers are known to come up with and execute on many dumb ideas. And once again, just wanted to take the opportunity to remind everybody, thank fuck I've got my AG1 because I need the energy. I'm a very busy boy. I'm now creating content exclusively on Patreon and for my Twitter subscribers. New videos dropped on both platforms. BYD throwing in the towel over in China. Check that one out on Patreon if you haven't already seen it. I'm also continuing to post exclusive subscriber-only content over on Twitter at Stephen Mark Ryan. And in addition, as Twitter builds out its video capabilities, I'm actually posting early access to all of my daily YouTube videos to my Twitter subscribers. If you want to see the videos early, that's where to find them. Otherwise, you watch them free here on YouTube. I don't mind. So let's get into it.
All right, Tasha, let's talk about this very, very bullish call. $2,000 a share by 2027. You're raising your price target when a number of analysts on the street slashed their price targets because they were worried about margin pressure. What are they missing?
I'll take that one. What are they missing? The big picture, but also all of the little pictures, as well as the big picture. Sorry, that was rude. Over to you, Tasha. I definitely think Tasha's going to have a very different answer to mine.
Well, I think the concerns over margin pressure are very short-term oriented. We've heard Tesla say this, but we've actually modeled the opportunity in robotaxis, in autonomy. And if you look at the future of, Tesla vehicles that are capable, becoming robotaxi enabled, earning a recurring revenue stream at what we think will be software as a service like margins. This is an amazing potential for Tesla. It'll definitely be, the highest return on investment per battery produced, as we've analyzed in our new report up on our website. So I think that, again, this will totally change Tesla's margin structure in the future. They mentioned on the earnings call that they're prioritizing getting cars out on the road. I think that's a smart decision as opposed to, keeping margins high and prices high in the short term. They just want to get as many cars out on the road as possible. Those cars feed Tesla's data engine, and that's what turns each of them into a fully autonomous car in the future.
Some facts have been spat. Again, Tasha's pointing out that Wall Street, extremely short-term, short-sighted, missing the bigger picture. No one seems to believe that A, autonomy will happen, and or B, it will happen in a reasonable time frame, and or C, that Tesla has an unassailable lead with the generalized solution, and or D, successfully solving autonomy will unlock a multi-trillion-dollar opportunity. I, for one, am actually quite happy with this misunderstanding between short-sighted Wall Street folks, short-sighted investors, and those who understand the bigger picture. Tesla stock today, in my opinion, absurdly cheap, hence still buying with every spare cent. I don't exactly know when the market will figure out the potential with autonomy. Between you and I hope it's not until the robotaxis start awakening. Probably still going to be buying then too.
Yeah, Elon said on the earnings call he thinks they could achieve fully autonomous this year. Is that your expectation?
So we have a Monte Carlo model with a range of assumptions. The midpoint of our expectation is in 2024. So it'd be later than Elon says. In our most bullish case, I think they could launch fourth quarter this year. But again, the real thing to look at here is, whether or not it's fourth quarter, whether or not it's next year or the year after that, this is an amazing opportunity. We think the market for robotaxis globally could be worth, $9 to $10 trillion in the next decade. So it's clear why Tesla is pursuing this opportunity. And again, with their data advantage and their verticalization, they really could be a leader here.
Oh, is that all? A mere $9 to $10 trillion. Yeah, I don't know why Tesla's aggressively pursuing this opportunity. It's not like $9 to $10 trillion is gigantic. Yeah, I think Tesla should focus all their efforts right now on advertising to sell their products at similar prices to today rather than getting more vehicles on roads, building the fleet, collecting more data, and over time, having many more millions of vehicles on roads that can operate as robotaxis. I don't know what Tesla's doing. They're obviously doing it wrong. Tesla's strategy is affecting the performance of my investment fund. Therefore, I need to be loud and make a lot of noise about the fact that Tesla's currently sacrificing margins for growth, because my investors and my clients are demanding that my fund perform better over the next quarter instead of the next decade. Wait, what? That was weird. I better edit that out. Someone might get offended.
So Tasha, that's a little bit down the line. When we talk about maybe the next year or two.
Absolutely hilarious. Did you notice that? Tasha's talking about over the next decade, the multi-trillion, literally a $10 trillion opportunity. Anchor. That's a little bit too far into the future, Tasha. How about tomorrow and yesterday and next week? How about the very short term, Tasha? This sums up Wall Street and the finance media in a nutshell. Short term, short-sighted, short on grey matter. Way to miss the forest for the trees.
With Tesla, of course, when they continuously cut the prices of vehicles, a lot of people are asking if there's a demand issue. Are you seeing any sign of that?
So, again, the story here, if you take a step back, is really that EVs are gaining share. So Tesla was harping on this on their earnings call recently, that you should think of them as a share of the total global auto market as opposed to just the EV sector. Because, again, in the future, it's going to be electric vehicles. So, my partner analyst, Sam Kors, has done a lot of great work looking at the electric vehicle market. We think that there'll be 60 million units sold in the next 5 years annually. And, that's up from, single digit percentage points as a percentage of auto sales today. So I think that Tesla here is really in the lead. They have a multi-year advantage over competitors. It's, again, that verticalization strategy that keeps them in the lead. So we think on an efficiency basis per cost for the price that you're paying for the car, they're still way ahead of the competition. And, I'd be pretty scared if I were a traditional automaker right now and I saw Tesla cutting prices, I'll tell you that, because
I concur with Tasha. I mean, I really think that legacy automotive manufacturers right now, if they even have half a brain cell between them, are shitting the bed. How the fuck do we compete with Tesla? We're losing tens of thousands of dollars per EV sold. They're making over $10,000 per EV sold after price cuts. And now they're cutting prices even further. What do we do? Maybe we should just give up. Shout out to the news about government motors.
Not all of these platforms are profitable at other automakers yet.
Yeah, there's some very slim margins, do those traditional automakers. So there are the margin concerns. There's also this group of shareholders that own a combined 1.5 billion in shares. They're concerned about something else, and that is a distracted CEO, of course, Elon Musk. They write in this letter to the board, "We have grown increasingly concerned with governance and leadership issues at the company. Tesla needs a board that will ensure that the CEO is focused on addressing its challenges." Are you concerned about Elon Musk being distracted with Twitter, SpaceX, and everything else he takes on?
I have a message to deliver to these investors. You know what? You can just sell Tesla stock, also known as fuck off. That's an option. 2, it's strange, isn't it? Elon Musk has simultaneously been CEO of SpaceX and Tesla. Oh, and then there's a whole Boring Company and Neuralink, plus the founding of OpenAI. Why is it only now people are concerned that Elon's distracted? The reason isn't that Elon's distracted, as we can see. We can just look at Tesla's execution. The company's executing just fine. He ain't distracted. The issue here is that these investors are butthurt because Tesla stock's not where they would like it to be. They're looking for a scapegoat, someone to blame, somewhere to point the finger. I would recommend these folks just sell their stock and fuck off. But hey, that's just me.
Well, it's not a surprise to us to see him tackling many issues at once. As you mentioned, SpaceX, he was one of the founders of OpenAI. We've seen him spread out his responsibilities among his companies. And really, what do we have to go off of? It's his execution. Look at Tesla's progress today from 5 years ago. Again, it's the leading company in electric vehicles. We also think so in autonomy. And I think he's a really crucial figure to actually crossing that finish line to creating a fully autonomous car. So we have full confidence in him as the leader of Tesla, and in fact, we'd be more worried if he were stepping away from his responsibilities. I think that while yes, it's shocking that he's able to manage this many companies at once, this isn't something that we haven't seen him do before.
You're happy if he stays on board as CEO of Twitter beyond this year?
I really would hate to be an NPC who just doesn't listen. Again, as Tasha pointed out, results are what matter. Tesla's execution is what matters. Tasha is about to say, we don't give a flying fuck as to whether or not Elon Musk is the CEO of Twitter, as long as Tesla continues to execute. Counting down to this exact statement from Tasha. I haven't watched this, by the way, so I could be embarrassed. 3, 2, 1, over to you.
Yeah, so, we are invested in Twitter in our private fund here at ARK. So I think that a lot of the ideas that he's put forward there to have the potential to really change the company and particularly the payments platform aspect of things we're pretty excited about. And our fintech team has done a lot of research there. But again, I think going back to Tesla, I'm not concerned with him splitting his time. We're going off of his execution here, and he's been an amazing leader. He's built an auto company that's really unrivaled in its autonomy and AI advantage, its software advantage, and its battery advantage.
Tasha, what about the Cybertruck? Certainly that has drummed up some excitement. Of course, it was mentioned a couple of times on the most recent earnings call. How important, or is it important at all, to the investment thesis?
What I think is so interesting about Cybertruck is it's just another way that Tesla is really efficiently producing cars. So, the no need for paint or any coating, one single piece over the body of the car. It's a lot cheaper to make than, say, the Model 3. Or at least the frame of it is. So we think that, the next generation vehicle that Tesla announced, which is going to be half the cost of the Model 3 and Y platform, that could potentially be a vehicle that looks similar to the design of the Cybertruck. And again, they do that because it's the most cost efficient way to produce these vehicles. And if you have a robo-taxi fleet, that's bringing down costs, we think that an EV already makes a ton of sense for autonomy on a cost per mile basis. And this is just going to, push Tesla even further over that edge of making an extremely efficient platform that'll lower the cost of transportation for people globally. All
right, Tasha Keeney, ARK Invest Director of Investment Analysis and Institutional Strategies. Thanks so much.
Surprise, surprise, I was right. I did predict. Tasha did, in fact, once again reiterate what she gives a about is Tesla's execution, not Elon's perceived distraction. Now, before we get to GM giving up, how embarrassing, some new research from Morgan Stanley discussing Tesla, their unassailable cost advantage and the implications for legacy automotive manufacturers. Spoiler alert, we kind of know how this ends. A large number of bankruptcy filings later this year. But anyway, let's see what Morgan Stanley have to say. Will legacy OEMs blink on EV growth? Price target still $200 per share. What's the optimal response by legacy car companies following Tesla's EV price reductions? Spoiler alert, just give up now. Sorry, I misread that. Try to keep up with the cuts or stand your ground and sell fewer EVs. We think it's more the latter and see the scope for spending cuts and improve capital discipline. So think about this for a moment. And to be clear, I'm not judging Morgan Stanley's assessment of what automotive manufacturers might do. They're just saying here's what they might do, not what they should do. But just consider for a moment how short-sighted a company would need to be to slow down their EV production, to slow down their EV sales. When the world's transitioning, EV sales growing exponentially, ICE vehicle sales collapsing. Just think about the level of potato necessary to slow down. In a recent Bloomberg article, Ford CEO Jim Farley was quoted saying in response to Tesla's price cut, quote, "Price wars are breaking out everywhere. Who's going to blink for growth?" We think Farley's quote captures the decision facing legacy auto companies who are on the verge of moving from small and niche scale EV production to high volume production. Where the Morgan Stanley auto team stands. Readers of our research know well our evolving views on the plight of legacy auto companies moving headlong into the next unknown phase of EV industrialization. The management teams and boards of legacy OEMs must consider a range of factors in a highly dynamic environment, including trailing edge of the cost curve. Morgan Stanley coming out swinging with some facts here. Ready? We believe there is a material gap in cost per unit between legacy OEMs and Tesla's current EV architectures. Tesla wants to further reduce the cost per unit for its EVs by another 50% and go further from there. These are what we call the facts, and they don't paint a pretty picture for Tesla's so-called competition. Morgan Stanley are right. There is a material gap. Tesla has a huge cost advantage on their existing platforms. They're making industry-leading margins selling vehicles for the same price point that their so-called competition are losing tens of thousands of dollars per vehicle sold. And just a couple of months ago at Investor Day 2023, Tesla showed plans, a new manufacturing system and some innovations in the motors and other bits and pieces that combined will reduce the cost to produce a compelling EV by another 50%. I mean, the writing's on the wall. Legacy OEMs simply cannot compete with Tesla on cost, and this will not change throughout the decade. How long can they lose money? Now this is a good question. With few exceptions, we expect the EV programs of the legacy OEMs to remain, wait for it, loss-making for years to come. And this was prior to Tesla's latest price cuts. We forecast Ford's EV business to remain in an adjusted EBIT loss position through 2026 with long-term margins, oh Jesus, of just 3.2%, roughly half the margins of the ICE franchise. For Government Motors, we don't expect their EV business to achieve a positive profit before 2027. You did it, Mary. Now, think about this for a moment. Tesla's already a money-printing machine with industry-leading margins. Their EV business is literally printing billions of dollars per quarter. Now, obviously, there'll be ups and downs here and there, but it's clear they have cost leadership. Between now and the final point in time when these companies like Ford and GM may start making a minuscule profit on their electric vehicles, Tesla will have released their next-gen vehicle. They'll be developing the subsequent generation after that. I mean, how do they compete? Think about this. Tesla's already developed a plan for a 50% cheaper EV. This thing will be in mass production before these companies are starting to make any money on any of their EVs sold. And at that point in time, consumers will literally need to have rocks in their head. Imagine you can buy a Tesla, compelling vehicle, in today's dollars, give or take about $25,000 in, say, 2026, 2027. Or you can pay literally twice as much and buy an equivalent vehicle from Ford or GM. Even from the consumer's point of view, you really do need to be a potato to pay twice as much for the same product. And from the business point of view, if one of these companies has 25+% automotive margins and the other companies have 0, 1, 2, 3.2% margins, as Morgan Stanley are expecting, why even bother? Make almost no money on your products that no one wants to buy. Oh, and then there's the whole collapsing ICE sales and collapsing ICE profits, which these companies are going to be reliant upon to continue to stay alive until their EV business can actually make money. Just between you and I don't think the ICE profits are going to be here for much longer. Potential obsolescence risk. With global EV penetration only recently passing 10% of sales and 8% in the US today, technologies around EV design, electrical architecture, battery form factor, supply chain and software are all in play and constantly improving. Without singling out any particular OEM, we would not be surprised to see the industry begin significant write-downs of their earlier EV investments in the coming years. In other words, many of these companies will have pissed away money pursuing dead-end EV technology. I personally won't single out any other companies either. And in totally unrelated matters, I wonder how that
Ultium platform is going. You know, the Ultium battery platform that's better than everything else.
Mismatch of sources and uses of capital. Boards must decide if having EV growth strategies funded by runoff ICE cash flows, by the way, not going to end well, is the correct use of capital. The prevailing argument to date is that having a Ford Lightning EV funded by Ford F-150 ICE cash flows is the ideal yin and yang of capital harmony. We are not convinced of this and expect to see over time a greater level of independence, if not total, containerization of the ICE cash flows and the EV spending plans. Now, this will probably happen, Ford laying the foundation to spin off their EV business and let the ICE business go bankrupt. But people aren't getting this. Morgan Stanley aren't getting this. No one's getting this. The cash cow currently known as ICE vehicle sales is going away faster than anyone realizes. ICE sales are in freefall. The less people buy, the more they cost to make. Fixed costs stay the same. You have reversing economies of scale. The very products these companies are reliant upon to fund their loss-making EV business, that cash flow is going away. What then? Something to ponder. Return on capital. Given the need to invest in EV transition, the automakers haven't prioritized near-term shareholder returns in recent years. However, the industry is known for doing more with less when things get tough. As opposed to Tesla, who just do more with less all the time because it makes more sense. We believe Tesla's recent quarter is a pretty strong indicator for the long-term direction of returns in the global EV industry. And I'm going to jump in here. I don't. I'll talk about why in just a moment. But I vehemently disagree on this point. It's indicative over the short term, but more on that in a moment. The price for being a competitor in the EV world dominated by Tesla and the Chinese OEMs may be to surrender, to accept being a smaller company. One way to avoid getting caught up in a price war is to be comfortable not selling that extra EV. This is real life. They may have a point. I think this is probably the way things play out. These companies realize, well, we're not competing with Tesla in the mass market. How can we differentiate our product and just sell a few of them to a few people that really want to be different? Now, regarding Morgan Stanley's comments that Tesla's recent quarter is a strong indicator for the long-term direction of returns in the global EV industry. Wrong. Morgan Stanley seemed to be unaware of the fact that EV costs themselves are predictably and precipitously declining over time as production scales up and new innovations take place in terms of manufacturing, batteries, and so on. Once again, I have to repeat myself for the trillionth time. By the end of this decade, a company like Tesla will be able to produce an extremely compelling electric vehicle for maybe $12,500 US in today's dollars. If Tesla were to sell those vehicles produced for $12,500 for $18,000, 44% gross automotive margin. To be crystal clear, the cost to produce compelling electric vehicles is going to plummet throughout the decade, and as this happens, the potential profit margins on these things is going to grow. To give the most extreme example to illustrate my point, if a company like Tesla could today produce a Model Y for $1, they would not need to sell it for $1. You understand? They would need to sell it for a reasonable price point to manage order flow with a very healthy margin. This is what's going to happen over time. For some reason, people today just cannot fathom. They think, well, companies are just going to have to keep cutting costs and reducing margins. They'll never be able to make high profits on electric vehicles because it's not possible for them to make electric vehicles more affordably than they do today. Not going to age well. Morgan Stanley are thinking, well, Tesla's currently cutting prices because we think no demand, therefore margins are going to be very low on electric vehicles in the future. The end. They're really missing the big picture here. The Tesla-China EV sandwich. There are two powerful EV regimes forming in global autos, Tesla and the Chinese OEMs. By the way, they are correct. Good point, Morgan Stanley. What do these groups have in common? The most important are low cost and high scale. An ability to self-fund their ambitions either with internally generated cash flows and or government support are also to be considered. A relative IRA disadvantage, as in Inflation Reduction Act. It's tempting for an old guard autos analyst like myself to want to believe how tens of billions of dollars of taxpayer incentives can help level the playing field or raise the tide for the broader EV industry at large, improving the fortunes of all players, including the legacy OEMs. Regardless, the relative scale and cost advantages still stand out and can represent gaps in operating margin that could be measured in the thousands of basis points. Our reading of the IRA incentive structure for EVs is that it's significantly more positive for Tesla than non-Tesla players, potentially widening the gap in cost performance. The idea that there's margin to keep for shareholders is specious and doesn't fully consider auto industry structure and excess EV capacity, in our opinion. A note on Tesla's capex guidance in the most recent 10Q. Many of you will already be aware of this, but just in case you're not, a number of clients noticed the recent disclosure from Tesla at the top of page 25 on their 10Q, where the company projects capex of between $7 billion and $9 billion per year from 2023 through 2025. This outlook is in line with our forecast. In fact, our average annual Tesla capex forecast of $8.8 billion through 2025 is materially higher than the midpoint of this guide. Why might Tesla be ramping spending? A relatively stale production lineup ready for a refresh. Global footprint too China dependent, still trying to diversify geographically. Growing established and installed footprint requiring more maintenance. Even greater vertical integration into cathode and lithium refining. Consistent with the recently updated and more aggressive pricing strategy, growth over profit. Tesla is in a far better position to invest on the back of IRA, but needs to spend to make money. To reinforce, we would expect Tesla to err on the high side of this $7 to $9 billion guide. And ladies and gentlemen, a few words on Tesla's extremely aggressive increased spending plans. Wasn't that long ago that I was banging the drum, hey Tesla, share buybacks, hello, can you at least get approval for these fuckers and buy opportunistically? At the time, of course, I did caveat if Tesla's aggressively spending, they're increasing their spending plans, they've got projects we don't know about, it doesn't make sense to do share buybacks right now. But if not, at least get approval, and if the opportunity arises, pull the trigger. Well, it's quite clear now why Tesla has not got approval for share buybacks. In the next 3 years, they'll spend essentially all their current cash. Now, don't panic, because they're still generating a shitload of cash every quarter. This spending over the next 3 or so years, give or take $20+ billion. And that's heading into a recession. Now, it may not be the recession of all recessions, unlikely, but we've got a little bit more insight now. Makes a lot more sense as to why Tesla wasn't pushing hard for buybacks. And I still want Tesla to get approval for share buybacks. Just get approval. And if it turns out this isn't the 0.001% recession of all recessions, and Tesla's selling through production still with very healthy margins, and the stock's still getting absolutely crushed, why not? But it just goes to show, I think Tesla has seen a huge opportunity here and realized, fuck dude, shit's imploding right now. This is our opportunity to gain a staggering advantage over everyone else in the industry. Fuck it. Let's accelerate everything. Now, this is a lot of money, like a lot of money. Seems to suggest that Tesla wants to get their Mexico factory built in record time. They've literally said this, they're going to try and beat the Shanghai build speed. But this is music to my ears. The fact that Tesla is massively increasing their planned spending, heading into a recession, uncertain economic times, is brilliant. At the same time, per Morgan Stanley's note, where legacy OEMs are like, maybe we should slow down our EV spending, people aren't buying cars. What do we do here? Let's just slow down. At the exact same time this is happening, Tesla's accelerating their growth plans. I love it. But yes, I really still do want Tesla to get share buyback approval, but I trust them to know if and when to actually pull the trigger opportunistically. They know many things that we don't. Meanwhile, in the land of government motors, so less than 24 hours after I posted an exclusive Patreon video in which BYD literally announced that they're giving up, you can't make this stuff up. GM to end production of electric Chevy Bolt, its first mass market EV, later this year. In case you don't know, Chevy Bolt actually sells decent numbers. If you can't afford a Tesla, the Bolt's not that bad. So why would GM stop producing this thing when they're selling more of these than anything else and it's selling more of it than most other electric vehicles? You have to ask the question, and well, it's kind of obvious when you think about it. They're not making any money on them, which is embarrassing, but then again, what about GM isn't embarrassing? Government Motors plans to stop production of its electric Bolt by the end of this year. CEO Mary B.S. Barra told investors Tuesday, "You did it, Mary, you led. You electrified the whole..." Okay, I'm going to stop, I swear. The Chevy Bolt EV and EUV, a larger version of the car, make up the vast majority of the company's electric vehicle sales to date. Again, just think about this. This is also a window into other electric vehicles from legacy OEMs and EV startups. If you're selling a shitload and you're still not making any money on them because you're trying to compete on price, you can't keep selling them at losses forever. GM literally just pulling the fucking plug. It's like, well, we ain't making money on these fuckers. Why are we selling them? The battery cells in the cars are an older design and chemistry than the automaker's newer vehicles such as the GMC Hummer and Cadillac Lyriq, which utilize GM's
Ultim
architecture, which is apparently the best battery architecture on planet Earth, according to GM themselves, who you can definitely trust because they tell the truth to their investors. Government Motors plans to stop production of its electric Bolt models by the end of this year. Barra said a suburban Detroit plant that has produced Chevy Bolts since 2016 will be retooled in preparation for production of its electric Chevy Silverado and GMC Sierra trucks scheduled for next year. There's irony in the timing of the Bolt getting axed. It comes amid record production and sales of the vehicle for mass market consumers, which was GM's initial goal. The company plans to produce more than 70,000 Bolt models this year, as it targets to sell over 400,000 EVs from early 2022 through mid-next year in North America. GM pushed the Bolt out ahead of the Tesla Model 3 in 2016. The two were considered to be the first long-range EVs designed for mainstream drivers, starting at around $35,000. But, stunningly, Bolt sales never caught on as well as many executives hoped. By the way, hope is not a strategy. As EV sales overall remained minuscule outside of Tesla, the Bolt also suffered a major setback more recently, as GM recalled all of the Bolts ever produced, I'm sure it's nothing, due to a supply-related battery issue that caused several fires. When the Bolt EV launched, it was a huge technical achievement and the first affordable EV, which set in motion GM's all-electric future. Blah blah, more EVs later this year based on the amazing Ultim platform. GM expects to launch its upcoming EVs far faster than it has its high-end Hummer models and Cadillac Lyriq, which have been rolling out at a snail's pace compared with its traditional vehicles. It's definitely not because production is hard. I'm sure that they have a very good reason as to why they've been rolling out very slowly, and I just don't know what it is, because you'd think they'd want to roll them out as fast as possible and sell a lot. But anyway, who am I to question GM's strategy? Barra said when the Orion, Michigan plant, which currently produces the Bolts, reopens and reaches full production, employment will nearly triple and the company will have a capacity to build 600,000 electric trucks annually. GM has set a target to reach production capacity of 1 million EVs annually in the US and in China each, as it attempts to catch up to industry leader Tesla. The Bolt models, starting under 30,000, are the least expensive new electric vehicles on sale in the US. GM's upcoming Equinox EV is expected to have a similar starting price when it arrives this fall. So to recap, Government Motors giving up on their best-selling but money-losing electric vehicle to produce more money-losing electric vehicles. Good strategy, GM. Hope that works out for you. ARK Invest continue to focus over the long term, and the finance media continue to look no further than tomorrow, which is approximately what Wall Street are doing at the moment as well. I don't know how else to say this other than I will be clipping these videos to relentlessly roast everyone who is panicking. Oh, Tesla margins are down this quarter! When autonomy has been solved and the robotaxi fleet awakens, and I look very much forward to it. And Morgan Stanley possibly rightly suggesting that many legacy automotive manufacturers might take this opportunity to slow down their transition to EVs and decide that they'll be happy selling less electric vehicles rather than more. I mean, honestly, it doesn't really matter. They're all going bankrupt before the decade ends anyway, so who cares? And remember, this GM news today, less than 24 hours ago, I posted an exclusive video on Patreon about BYD themselves giving up. Check it out if you're a Patreon member. Unbelievable. So much going on right now. Like I said, glad I got my AG1. I need it. And now, your daily reminder. You got to check out Athletic Greens AG1, which I've personally been taking now for more than 2 years, and I absolutely swear by it. As I mentioned yesterday, if you hate your life, you eat like trash, you don't exercise, you don't give a shit, you don't get enough sleep, you got bigger fish to fry, don't bother. If, on the other hand, you do value feeling and performing your best, and you're not taking Athletic Greens AG1, I think you're missing a trick. Hence, I'm doing my best to try and have a positive impact. I'm always looking for ways to feel and perform my best, and AG1, no doubt, is the best bang for buck. It's not the only thing I do, but in terms of the return on investment, there's nothing that comes close. It's packed full of 75 high-quality vitamins, minerals, and whole food source nutrients, plus digestive enzymes, prebiotics, probiotics, and adaptogens to help you deal with stress. Plus, if you head to athleticgreens.com/SMR or click the link in the pinned comment, you get yourself a 1-year free supply of vitamin D3 and K2+, 5 travel packs. Try it for a month, and if you don't get the results you're looking for, just get your money back. After all, that's why the money back guarantee exists. What do you got to lose? You don't have to take my word for it. Check out these recent testimonials from viewers of the channel. After nearly 1 month on AG1, I'm less sleepy, have more power until late evening, more attention without being edgy. It's life-changing, positive. This particular viewer is suggesting they feel like they're in their 20s. They're currently 38 years old. I've had a similar experience myself. No kidding, I feel like I'm 20 years old again. And I'm almost the same age as this viewer. After 4 months of using AG1, I have only one problem. I want more. I like bigger scoops and would run low before the next pouch would show up. So today I made a double order. Love your content. Thank you. You're welcome. Yet another newly discovered benefit of AG1 is my golf game. Finally got out here on a golf course. Don't want to reveal too much personal information. Golf is primarily a test of mental strength and positive thinking and focus. AG1 seemed to have amplified all of these, as well as my body feeling loose, less sore, and less aches in the joints after play. Amazing. A lot of people sharing similar results. It's almost as if you give your body everything it needs to feel and perform its best, which includes recovering from exercise and physical exertion. You get results like these. Been using AG1 for 2 months now. I'm 22 years old. I've certainly gained a substantial boost in energy that helps me get more done throughout the day. Before AG1, I used to work 4 hours in the morning and 2 hours in the afternoon before noticing a substantial drop in performance. Now I'm able to squeeze out 8 to 10 hours a day of high performance work. So in short, AG1 made me 40% better. Decided to buy AG1 a few months back. I have more instances where I just feel generally happy, positive, for no reason. Many other viewers have similar experiences, by the way. Again, if you're giving your body what it needs for optimal performance, it can have a very positive effect on your mood. I don't have anxiety or depression, but I usually get these random spurts of joy on particularly good days, or when things in life just feel right. I was surprised AG1 has made this happen more often. I also had an instance where an AG1 pouch was punctured during shipment. Contacted support chat, and within 5 minutes they said they would send a replacement. No questions, no hassles. The replacement arrived within 4 days. After 3.5 weeks or so on AG1, it accomplished what I hoped it would by getting rid of a very nasty head and sinus cold, and yes, seemed to give me more energy and a little brighter outlook on life. And finally, AG1 Day 60 update. It makes me feel slightly better 100% of the time. Well said. So what are you waiting for? Head to athleticgreens.com/SMR or click the link in the pinned comment. Start your daily health habit now. Try it for a month, see how you feel. What's the worst that could happen? You only feel slightly better 100% of the time. And now I feel, excuse me, time to use some of that extra energy that I'm personally experiencing from AG1 to create some more exclusive content for both my Twitter subscribers and my Patreon supporters. If you're not on both, you're really missing out. So, see you over on Twitter and or Patreon. Love ya.